I know you're going to be shocked when you hear this, but you can't trust every financial advisor.
Move the money from your client's pocket into your pocket.
I know, crazy, right? Like, I thought you could trust all of them. Who knew?
Who knew? Who knew?
There's no question that there are shady advisors that are doing some very dirty things, but there are good advisors out there that are doing some amazing work. But how can you tell the difference? Like, if your advisor isn't blatantly stealing from you, how do you know that they really have your best interest at heart? Say, for example, they make a recommendation to change something in your portfolio that maybe you don't fully understand. Are they doing so because they really want to make sure that you either make more money or have less risk or increase your diversification? Or are they making a suggestion because it's going to pay them more and help them make more, which is really not what you want? Sure, you want them to make a little bit of money, but you also want to make money and not at your expense. So that's exactly what happened to some good friends of ours. They reached out to me because they knew that I was a former financial planner, and their advisor had made a recommendation that they weren't sure if the guy was being legit or there was some shadiness going on.
Will the real Slim Shady please stand up?
So they wanted me to take a look. And the reason I'm doing this video is because when I took a look, I saw that this was borderline shady, but it was really, really hard to determine. Like, it was definitely that gray area. It wasn't black and white. Like, he wasn't stealing money, but the recommendation was something that I want to talk about, because chances are, if you have worked with a financial advisor or plan on working with an advisor, this could happen. I don't want any shady financial advisor taking your money. So let's find out the story, the question to ask to make sure that you are protected and that you don't have money taken from you. So let's find out what the story is right now. What is going on, y'all? Welcome back to the channel. I'm your grateful host, Jeff Rose, and we're going to tell a little bit of a story today. A little bit of a story, and this is one of those I am grateful that I have some experience as a financial planner. For those that are new to the channel, new to the podcast, so I was a financial planner for over 16 years. I still have my CFP designation, which stands for Certified Financial Planner. So the benefits of that is that I have all that experience of being a financial planner. And then also, whenever I have friends, family members that have questions about their finances, or even better, about their financial planner, they can come to me and I can give them a straight, no BS. This is what's going on. Like, this is what's really going on. Now, I will say a majority of the time, most of these financial planners are doing a good job. I didn't say an amazing job. They're doing a good job, meaning that they're not slime buckets trying to take advantage of somebody that doesn't know what's going on and trying to milk them for every single dime. But there have been some situations where, yeah, they were trying to take advantage of the client. It maybe didn't seem like that they were doing anything shady, but when you started asking the questions, like, why are they recommending this? What is the point? Is there really some sort of value added to the client? Is there some way of reducing their risk or giving them greater diversification? When you start answering all of these questions and then you don't get the answers that you're really looking for, then you kind of know, okay, yeah, there is something up here. This is not a benefit to the client. This is a benefit to them and their checking account, meaning that they are going to get paid for what they are recommending. So this has been a little while ago. We had some friends, you know, that knew that I was a financial planner, and they wanted to get my opinion on a recommendation that their financial planner had suggested. I don't know how long they had been working with this said financial planner. I think it was a few years, and it could have been like 3 or 4 years. So they had a decent working relationship with them. So what this advisor was suggesting was that they would take their current investment portfolio, which was a majority of all mutual funds, and we're going to talk more in greater detail of what kind of funds, because that's very important to the story. So they were suggesting that they should take this portfolio, their mutual fund portfolio, and then move it into this more of a managed portfolio. So once again, I've been around the block a few times, so I get, when I hear the word managed, what I am hearing is they are going to charge a higher fee. First point of interest, if you have a financial planner, if you're working for a financial planner and they are suggesting a change or suggesting some sort of portfolio, and they use the word managed. Managed. That means that there's going to be a fee associated with it, and chances are it's going to be an ongoing fee. Now, is that really a big deal? Like, oh, maybe that means it has more management. It's being watched more changes are happening. You know, maybe they're selling when they need to sell and buying when they need to buy. So sometimes having something that is managed properly, that's not necessarily a bad thing. But let's just hit pause right now. Let's find out exactly what these people had and why offering or switching to a managed portfolio was a bigger deal. This is what was going on. My friends, the clients of this advisor, they had a mutual fund portfolio that was with the American funds. So let me just go ahead and pull this up real quick so you can see the American funds family. This is just a mutual fund company. There are, I don't even know, dozens, if not hundreds of mutual fund companies. So American Funds is just one of the many that exist. So this is like the equivalent of like a Vanguard or a Fidelity. This is who they are. Now, one thing to be said about the American Fund family is that this is a mutual fund company that you will see highly recommended by a lot of financial advisors that are making a commission. And not to pick on Edward Jones, but there was a time, and maybe it still is, where anytime I looked at an Edward Jones statement from anybody, they had American Funds. One way or another, they had American Funds. American Funds is not a bad mutual fund company. They're a good company, decent company. They did really good back in the 2001, 2002 bear market. Fast forward to 2008, which, my goodness, that feels like forever ago. They did not hold up as well. And then a lot of people started then selling them and getting rid of their American funds. But nonetheless, like that's what my clients had. So they had an American Funds mutual fund portfolio. And I don't know exactly how many funds they had, and actually it really doesn't even matter. But you can go to their website's capitalgroup.com, that's like their parent company. And you can click on what they offer, and then you can start looking at all the different American funds that they offer. Once again, so this is what they offer. This is one of their many products, mutual funds. And this is what my clients, I say clients, they weren't my clients, they were my friends. This is what they had. Now, with any mutual fund that you buy, there is this thing called a prospectus. This is something that you get in the mail anytime you buy a mutual fund or an ETF. You're gonna get this little white booklet that shares everything that you need to know and really don't care about with your mutual fund or ETF. This is what their attorneys put together to make sure that you don't sue them. Bottom line. So that's why the prospectus exists. This is a CYA, cover their butt, making sure that they've covered everything, addressed everything that's going to prevent you from suing them in case you lose money, because you are going to lose money because it's an investment. You're going to lose money. So you get a prospectus, whether the advisor typically is supposed to give you one. If you don't get one from them directly, they're supposed to mail you one. And then every single year, or anytime there is an update, you will receive one. So this is what a prospectus looks like. This thing is 81 pages long. I almost said the cool thing. It's not really that cool. This is one of the things that we actually used, that I was trained on how to sell a mutual fund. So I guess I should go ahead and get this out of the way. Here I am like bashing other people that are selling A shares. And I don't say bashing, I'm just saying these are advisors that are making a commission. So full disclaimer, full transparency, when I first started in the business, this is how I was trained to sell mutual funds, and even more particular, to sell A shares. This is just what I was taught, to sell front-loaded mutual funds. The prospectus was used to show, what was the cost, how much was, what were the fees, and then just to kind of walk the client through how much they should expect to pay. I love the transparency aspect that we were trying to do, which we were, but knowing what I know now, I realize that there are a lot better ways to go, but that's not the point of this video. We can talk about that on a future video. What we're talking about on this video are A shares. So A shares are the mutual funds that you have different share classes that you can buy. Predominantly, A shares is what people are going to either buy or most financial advisors are going to sell. And I'm going to share with you how this works, how much you pay, and even more particular, what these people paid, my friends paid, whenever they bought their A-share mutual funds with American funds. Okay, so let's take a look at a real life prospectus. So I pulled this off of the American Funds, the Capital Group website. This is a prospectus for the Growth Fund of America, which is at the time, and I assume still is, their largest mutual fund that they offer. This is a mutual fund that I used to own myself back in the day. So this is like the first page of the prospectus, and this thing was like a little white booklet. The thing is, I mean, you don't read this stuff. It is so boring, but for those that love detail, love to get all the information you want to know about investing and everything that you want to know about the mutual fund, like this is where you start to really geek out. So as you start going through this prospectus, let me just show you. So this is, I'm not sure what page this is on, but this definitely is not on page 2, but it starts breaking down, like here are the different share classes. So you have the A share, and then you have the B share. I'm sorry, I just said B share, but the B share does not exist anymore. There used to be a B share, but until it was discovered that advisors were misusing them, mis-selling them, misrepresenting them. So for the most part, all you have is the A, C, and then they have these T and F shares or R shares, which are more, those are typically found in retirement accounts. The two that you all really need to know is the A and the C. So if an advisor is going to sell you, it's going to be one of these. 529 shares, that's for a college savings plan, just in case you're curious what that's about. My clients, they purchased A shares. That is the most common share class to purchase if this is something that is going to be held for the long term, which for the most part is defined anything greater than 5 years, maybe we'll say 7 years. As you can see here on the prospectus, you will pay a load, this is where they get the word load, 5.75% of whatever you invest. So that means that if you have, $10,000 to invest, you will subtract $575. That is the commission or the load that is taken out. And in case you're curious, the advisor gets paid 5% of that, and then the mutual fund company makes 0.75%. So if I were to sell you a mutual fund for $10,000, I would get paid $500. That's how it works. That is the incentive. But if you look at this over time, this is where you would make the case as an advisor. Well, yes, you're paying now, but over time, you are going to recoup those costs, because if you were to buy the C share, you're not going to pay anything up front, but you're going to pay a 1% annual fee. Like anything, if you think about that, right? Do you pay 5.75 up front one time, or do you pay 1% ongoing? Well, if you do the math, after 6 years, you are going to pay more with the C share. Now, for those that understand how this works, you also know then that there is another fee with the A share. You do pay what's called a 12B1 fee. This is the 0.25% that you pay ongoing. This is what the advisor makes, but you also have the management fee. Well, you have the management fee, the distribution fee, other expenses. So the total operating expense is 0.64. Compare that to 1.39 with the, whoops, wrong one. My bad, the 0.64 with the C share. So that's where all these fees come into play. So just kind of break this down real quick, just so that don't get lost in the numbers. So we have an A share where we pay a front end load 5.75%. And then we have the C share where we pay nothing up front, but then we pay a 1% ongoing fee, which is paid directly to the advisor, which is over and above what you pay as a management expense. Okay. So A versus C. Now, once again, if you are an advisor and this is something that people are saving for retirement, then the A share is supposed to make sense, because if you pay up front versus paying ongoing, you're going to pay a lot more with the C. You're going to pay a lot more with the C. Now, I wasn't there when the advisor originally sold these mutual funds, but having been in the game, I have to assume that this is how it was presented, okay? So keep that in mind. Now, one thing also to note or to share is that if you invest more than a certain amount, so and this is a little bit different with all mutual fund companies, but for the most part, it's very similar. So if you have $25,000 or less, then you pay that 5.75%. But if you invest between 25 to 50,000 with the American funds in this example, then you get a discount. So instead of paying a load of 5.75, you only have to pay 5%. Ooh, everybody likes discounts. So then if you invest more than 100, it goes down to 4.5. And then basically anything up to $1 million, you're paying 1.5. Anything over $1 million, there is no upfront load. You just have to pay the ongoing management expenses, which we talked about before. I don't know exactly how much my friends had invested, but I have to assume, just based off this, that they did get some sort of discount with the mutual funds that they purchased. Now, as I said earlier, I don't know exactly how long they owned these American funds, but based off my recollection and based on when they told me this, how it made me feel, I am assuming that it was somewhere around the 4-year mark, that they had these mutual funds. So they sold them, this advisor sold them A shares. I am assuming sold them on the idea that A shares are the way to go, because you are paying up front. You're probably getting a discount for how much you are putting into the American funds. And that's going to be a whole lot cheaper than owning the C share that has that ongoing expense. Okay? I think we're on the same page. So that's where we are right now. So then what did the advisor recommend that I knew that this was something that was definitely a little on the shady side? So what he was proposing was that we are going to get rid of the American funds and we are going to move this to a managed portfolio. As I said earlier, a managed portfolio means that you are paying a higher fee. Plain and simple. There's no getting around that. You are going to pay more, period. So why was the advisor recommending this change? Let me first start with why he was recommending it for the client. Why this was a good move that the client should make. So he was saying things like, you are going to get greater diversification because now instead of owning 5 or 6 different mutual funds, you're going to own a basket of mutual funds. Now you're going to have 12 to 15 different mutual funds, which is true. Which, is that really a good thing? It could be. But the thing that he said that I can remember, because this is where it's like, okay, this is a classic line from an advisor that is saying this to support his case that this makes more sense. So he went on to say, right now, like, I just don't have the time to manage this portfolio, like what you own right now. I'm moving all my other clients this direction so that they get better service, better management, and all this stuff. Okay. So like, I'm thinking, why would you say that, for one, right? So basically what this advisor is saying is that I don't have time to manage your portfolio, and I really haven't been managing your portfolio ever since I sold it. Otherwise, I wouldn't be making this change. Like, do you see that? Do you kind of see what the advisor is doing here? He's pretty much shooting himself in the foot. So now he's making the case that he needs to switch to this managed portfolio because I want to make sure that you're taken care of because I don't have the time to do it anymore. Now, the thing that was also mentioned, like, I don't remember the exact fee, but as I said earlier, I'm gonna pull this back up so we can back on the same page here on fees. So once again, I don't know exactly how much they had. I know they got a discount, so they pay like 3.5%, maybe it was 2.5% upfront. So somewhere, you know, they definitely paid a upfront cost on the investment. So let's say, you know, here's their portfolio. They end up paying their current portfolio. I'm just going to assume that they paid that 2.5% upfront. So they paid that upfront, and then ongoing, you know, they were paying about, that was year one. But then at the end of the year, they also had to pay for that management expense this way, which is like 0.65%, right? So then year two, they're also paying 0.65%. Year three, 0.65%. Year four, 0.65%, okay? This is what they have paid. And now, you know, this is their portfolio one. The advisor is suggesting that they move to portfolio number two, which has more mutual funds, has greater diversification. Now, with all of these, there also is going to be management expenses inside of the funds. So if we took just a general average, and let's just go ahead and apply the same number that we used over here. So year one, we've got the management expense for all the mutual funds together, you know, just kind of taking that percentage, like that, how much you're paying. But how the advisor gets paid is the key. This is the key, and this is why this is borderline shady. So whenever you move to managed portfolio, the advisor has to assess what is your management fee. And this is where oftentimes you'll hear the term fee-based, a fee-based advisor. So they are charging a percentage of the assets that they manage. This is not going on over here. So in portfolio one, they got paid upfront, and then they're getting paid of this 0.65, they're getting paid 0.25% ongoing that year, again and again and again. Under the portfolio two over here, like I said, I don't remember the fee, but I do remember it was somewhere in the 1% range, which is pretty common. 1% is the management fee that the advisor charges. This does not include the 0.65%. So my friends, the client, you, whoever this is, you would pay for the entire year 1.65% of the total portfolio value, whatever that is. And then guess what? Year two, you would pay 1.65% of the total portfolio value. Year three, nothing changes, 1.65%. And this is where the advisor is making more ongoing because now they're making 1% instead of the 0.25 that they were making over here. And this is when I get a lot of things. But essentially, you know, what's going on here is the advisor has reached this point where, they want to increase how much fees that they are generating on a reoccurring basis. That is what's happening here. No question. No question that's what's happening here. So they're just trying to increase that. And they're like, oh, well, I already have this client that has a couple $100,000 invested, and they got paid the A shares up front. And now 3 or 4 years later, they're going to increase how much they're making. And you do have to report some of this. Like, you know, did you sell the client any sort of A share in the last however many years? Like, you do have to disclose that. If they were with you with that firm, I don't know if you have to do it if, like, let's say you're with a different firm and you transferred into this firm. Like, I don't know if if you have to report it then. Either way, you're supposed to, like, let the firm know how much they paid in fees. That is something they do require now that they didn't used to. But for them to make this suggestion, and for the mere sake of saying that, oh, this is because I don't have time to manage your portfolio and I want to make sure that you're getting the best management available, this is what you need to do. But the part I find most humorous about the entire situation is that, once again, I was not there when they were sold the mutual funds. I wasn't there for that A-share conversation, but you have to assume that they made the case to buy A-shares because this is what's going to be cheaper for you in the long run. Pay the upfront cost, like take the hit up front, and then pay a lower annual expense ongoing. Well, as you can see, not only did they pay the large upfront cost in the beginning, but now after year 3 or 4, they're going to pay not just a larger ongoing, not just an ongoing fee, but they're going to pay a much larger ongoing fee. 1.65 compared to 0.65. Almost 3 times as much. And I assure you, that was not part of the conversation. Like, oh, by the way, yeah, I sold you these A shares and I know that I made a pretty fat commission a couple years ago. And I'm sorry that I made a lot of money, but here's the good thing. I found a way that I can get paid even more. And I'm going to use that. That is what's really going on. But I have this disguise of saying, oh, you're going to get greater diversification. You're going to get better management. And basically, I'm going to get paid more to do less, because the reality is that he's not managing anything now. Like, he's actually outsourcing this to a third-party manager who's doing all the work. He's doing even less work and he's getting paid even more. I keep saying he or she is getting paid even more for doing less. That is the rub. It's like, that is what's going on. And I wanted to share this because this is not an isolated example. There are other advisors that are suggesting something similar. And I want to just share this information so that you can protect yourself, so that you can ask the hard questions and ask, hey, this sounds really great, but how come I paid all this large upfront load a couple years ago and you told me like that was the way to go, and now you're telling me it isn't and you want to pay more? That is something that is worth asking. Like, you are worth asking that question. And if you don't get the response that satisfies you and maybe sounds a little shady, then you need to go to FINRA broker check, and you can actually file a report, file a claim against the advisor if you think that they are trying to do you wrong, if they are trying to double dip, if they're trying to, make a big fat commission check on the back at the front end and also make more on the back end. Like, this is not okay. This is one of the many type of financial advisors I would like to punch in the face. And yes, I am referring to a blog post, a video, and a podcast that I've done on that topic. Feel free to look that up. Title of that is 7 Financial Advisors I Would Like to Punch in the Face. Not literally, metaphorically, but then again, depends on how much of a jerk that they are. Maybe they do deserve a good uppercut. Give them a little jab, 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 right hook. Anyway, all right, y'all. Hope this was helpful. Hope that you understand more how the industry works, how you can protect yourself, and make sure that you're not going to get ripped off by a shady financial advisor. Until next time, this is Jeff Rose reminding you that it's your money, it's your life, and only you can make it awesome. Until then, peace.